It is entirely counterintuitive. The globe teeters on the brink of a massive, destabilizing war, yet somehow, your retirement account is quietly hitting record highs. This chart shows exactly how weird things got in April. On the evening of April 7th, Donald Trump announced a ceasefire with Iran. The very next morning, the Dow exploded for more than 1,300 points, its best day in almost a year. The Nasdaq jumped nearly 3%, and the S&P finished deep in the green. Traditional financial media looked at these numbers and immediately branded it as a relief rally. The narrative was simple and comforting. The markets were celebrating world peace. To find the real trigger behind this massive surge of wealth, we have to look past the headlines. We have to look at the physical shipping data out on the ocean. There is a maritime intelligence firm called Windward. They utilize artificial intelligence to cross-reference digital GPS signals with satellite radar to track exactly where physical cargo is moving across the globe. Their data showed that while the media was talking about a ceasefire, the physical reality on the water was a rapidly emptying ocean. The peace was failing in real time. This bar chart compares the normal shipping volume to that specific day. The pre-war baseline was about 130 daily transits through the Strait of Hormuz. By midday on the 8th, that number had collapsed down to just 5 outbound carriers, a 96% decrease in activity. If there was no actual peace on the water, the stock market wasn't rallying on optimism. An invisible mechanical force was manipulating the money. Going into April, Wall Street was quietly panicking. Following joint U.S. and Israeli airstrikes in February that killed Iran's supreme leader, the Strait of Hormuz was shut down. The market endured its worst 5-week losing streak in nearly 4 years. Based on data from Goldman Sachs's prime brokerage desk, hedge funds were aggressively positioning for a disaster. They were shorting the market at the fastest pace in over a decade, setting on gross leverage of over 300% and actively preparing for a scenario where oil hit $250 a barrel. This setup triggered the first domino, a short squeeze. When you short a stock, you are borrowing shares from someone and selling them. You are betting the price drops so you can buy those exact shares back at a cheaper price later, return them, and pocket the difference. But if a minor headline hits and the price starts rising instead, your broker issues a margin call. You are forced to urgently buy back those shares at a higher price to close the position. When thousands of traders buy at the exact same time, that immense pressure drives the price up further, triggering more margin calls. The 1,300-point surge on April 8th represents a forced liquidation event, the first domino in an automated chain reaction. Hedge funds were caught in a bear trap, and their mechanical buying set off the next stage of the process. Enter the commodity trading advisors, or CTAs. These are massive, systematic trading firms running entirely on rules-based mathematical models. They do not read the news. They do not care about Middle Eastern geopolitics. They exclusively follow momentum. If the trend is down, they short. If the trend is up, they go long. Crossing that mathematical trigger line forced these algorithms to bypass a neutral stance and flip directly into a long position. The sheer scale of this automated flip is staggering. Over just 5 trading sessions, CTA algorithms purchased $86 billion in equities. Goldman Sachs recorded this as a top 5 historical buying sprint. This massive influx of blind capital proves that major price action is driven by pre-programmed mathematical triggers, entirely divorced from human beings interpreting the evening news. The final domino to fall was the options market. The dealers sitting on the other side of these massive option trades have strict internal rules. They must keep their books balanced, a state known as being delta neutral. Heading into April, the market was in a negative gamma regime. In plain English, this means that as prices soar and customers pile into call options betting on further gains, dealers are forced to mechanically buy the underlying stock just to hedge their own risk and keep the scale balanced. It creates a self-feeding, pro-cyclical loop. The price goes up, which forces the dealer to buy more stock, which pushes the price up even more. That is the true anatomy of the April rally. A forced short squeeze, triggering algorithmic CTAs, which triggered options dealers. It was a completely automated cascade of math, disguised by the media as a geopolitical relief rally. This specific mechanical stacking is not an isolated glitch. In December 2018, the stock market had been crashing for months. Then, Fed Chairman Jerome Powell stood on a stage and said a single word: patient. The Dow immediately exploded for 1,000 points in a single session. We saw it again in August 2024, when the Bank of Japan hiked rates for the first time in 17 years. The Nikkei violently crashed 12% in a single day, only to bounce 10% the very next morning, driven entirely by these same mechanical triggers. The news catalysts are always different: a sudden rate hike, a public speech, or a ceasefire. But the underlying mechanical plumbing reacting to those catalysts is the exact same automated sequence every single time. As this pie chart shows, 63% of all U.S. stock funds are now held by passive indexers. That is more than $13 trillion of blind money that buys shares of large-cap companies by default, without ever reading a single quarterly earnings report. Even the active side of the industry has evolved. The giant multi-strategy hedge funds that dominate Wall Street operate on strict automated drawdown rules. When they hit a mathematical limit on their losses, they don't sit and debate the fundamentals of a company. They just sell. Between $13 trillion in passive indexing and high-leverage funds operating on mechanical drawdown rules, the discretionary investor has become a minority voice. When options dealers are forced to hedge $2 trillion in notional value in a single afternoon, analyzing a company's fundamentals becomes secondary to managing the machine's real-time reactions. The modern market functions as a massive feedback loop, where algorithms and dealers react to each other in milliseconds. Headlines provide a convenient narrative used to rationalize the machine's math after the dust has settled.